is Matt Orsog with the CFA Institute, and welcome to ESG Investing, Understanding Environmental Factors. We have a great panel with us here today, so I won't waste a lot of time. We'll just set the scene a little bit and we'll right into the discussion. A little housekeeping. We're going to speak to each of our panelists, but we'll be taking your questions during that time. So please send in your questions to us. And that'll be part of the second half of this discussion where we'll go, I'll moderate the Q&A and we'll have discussion about the Q&A with our panel. So without any further ado, let me introduce our panel. Andrew Wetzel, he's CFA, Principal Portfolio Manager, Managing Director of Sustainable Investing at Putnam. Jillian Marcel, who leads the Reliance Capital Ventures. And then finally, Preeti Shokeen, VP and Director of ESG and Research Engagement at TD Asset Management. So I will step out of the way. We'll have each of our panelists talk for 8 to 10 minutes about their perspective on things. And then, as I said, we'll spend the second half of the discussion having a more back and forth discussion and talking about your questions. So right now, I'll hand things over to Andrew. Andrew?
Thanks, Matt. Appreciate it. So I'm Andrew Wetzel. As Matt said, I run our sustainable investing practice at FL Putnam. I'm a portfolio manager. So I spend most of my time really focused on managing 3 equity strategies. That's the day job. And I've been doing that for about 20 years. FL Putnam is a investment management company. It's been around since the 1980s. So it's not Putnam Investments, it's FL Putnam. And we've been working with sustainably minded clients for the entire time we've been in business. And we've seen many different approaches and objectives, client objectives, over this course of time. And what we've learned is that there's no one silver bullet, there's no one approach that works for everyone. And so we've created a platform with different strategies to serve different client needs. So as Matt mentioned, the idea here, the point of this program is to talk about environmental factors. So when I put my portfolio manager hat on around fundamental active equity management, there are a couple of ways that we really bring in environmental factors into the portfolio management process, the research process. And so I want to talk about 2 really important ones, ESG, so the E in ESG, and then environmental thematic investing. So these are 2 very different approaches. ESG is about managing risk to the enterprise value of a company. And environmental thematic, or any thematic investing, is about understanding trends for growth that can be a tailwind for some set of companies. So one's about risk, one's about growth. Very different portfolio construction, different risk and return profiles in isolation. So thinking about ESG first. So ESG is about assessing the material, environmental, social, and governance risks for a group of companies. So a peer set, an industry. And the material factors are going to be different for each group of companies. So the material ESG factors for banks will be different than those for software companies or for industrial manufacturing businesses. They are fundamentally different businesses with different risks. So that's a very important framing point. As we think about the E in ESG, just to think about a couple of industries, in oil and gas, when we're thinking about an oil and gas company, we want to understand, the number of spills that they've had, the volume of spills, and importantly, where those spills have occurred. So a spill in West Texas is going to be very different than something that happens in the Gulf of Mexico or offshore Alaska. Very different situations. For an industrial manufacturing company, we want to understand energy usage. So if we think about those businesses, they can be very energy intensive. We want to understand what that's looked like over time, how much of it is grid electricity, how much of it is renewables. And that can give us a sense of how that business may act in different environments. So that's important. When we take a step back and think about talking to companies, engaging with companies around these issues, what are we trying to get at? We want to understand disclosure. Our companies disclosing the information that we need as investors to really make a real assessment of their risk. We want to understand who's involved, who's the lead in terms of the sustainable chief, who's the team around them, and we want to understand what they've done in the past. So what targets have they set and what have they achieved toward those targets? Then we want to look forward and understand what targets they set for the future. We want to be able to use that information to benchmark progress. That's really important on a go-forward basis. So that hopefully just gives a sense of how we think about a few metrics across a couple of industries and the type of information that we're looking for from companies. It's also important to note that when you do this kind of work, you really want to try to be able to compare apples to apples. So a lot of the data that we look at is normalized or intensity specific. So if we want to understand the number of spills or the volume of spills for an oil and gas company, we want to measure that relative to the total volume produced, as an example. So we can compare companies of different sizes. A couple of quick examples. So when I started in this business, I was an analyst covering energy and materials companies. So that's how I got the start. And in 2007, I was covering and looking at a couple of large oil and gas companies, one from the UK and one from Norway. And these companies had very similar valuation profiles. They had similar production and growth profiles. One of them, and they were both actually companies who were indicating to the market that they were looking toward the future, a more sustainable future. When you actually went below the surface and looked at the track record of these two companies, one had major problems, a big refinery explosion in the US and then a pipeline spill, so significant human capital and environmental footprint issues. The other one happened to just do an incredible job managing their environmental footprint and had very good human capital management. So when we look at those two businesses and thinking about comparing valuation, growth profile, financial strength, and then their environmental and human capital management, it's pretty clear which one to go with. And so we did invest in the one from Norway. Fast forward a few years, the UK company, and you probably all know who I'm talking about, was involved in the worst well blowout in the US, and the stock was down 55% in just a couple of months. So the idea here is that ESG integration, the E, can be a really powerful driver of risk-adjusted returns when it's part of a research process, part of a security selection process. That's important to note. Just to touch on quickly on a recent example, we know about all the terrible things happening in Ukraine today. That has ramifications on all of Europe, right? We know that natural gas prices are very high, and that leads to higher power prices, which can be a margin headwind for industrial companies in Europe. We know that there's a particular logistics business that we like, and that company's done a great job of integrating solar power into their mix. So they're more insulated relative to peers as power prices go up. So that can help insulate margins as we go into what will be likely a very difficult earnings season over the next few weeks. So that's another way to just think about risk within an income statement. I'm going to stop there on ESG and talk a little bit about environmental thematic investing. So again, pivoting from risk to growth and opportunity. And when we think about environmental thematic investing, it's about understanding a changing world and trying to pick up on the underlying trends that can lead to dislocation and disruption, and then investing into those trends. Understanding that there will be risks that we'll want to avoid, but really going after those opportunities. That's incredibly important. So we want to understand what are the issues, the environmental issues in this case, that really matter from a long-term perspective. What are the challenges we need to address? And then we want to think about how is consumer preference shifting? What's happening from a regulatory and governmental perspective? How are regulations shifting? We want to understand also importantly how investor attitudes are changing toward these themes and these companies. These are all important inputs. And we want to think about solutions. We want to understand, given these problems, where is the market going, right? Where are there potentially revenue tailwinds? And then we want to look down into the supply chain to understand how many different types of companies can potentially benefit from those changes, from those trends. To give a quick example, packaging is in the spotlight. We all know and have seen the videos of the turtle with a plastic straw in its nose, and there are many like that. You know, the reality is if you take a football stadium and fill it with plastic and dump it in the ocean, essentially you do one of those every day for a year, and that's how you end up with the volume that goes into the ocean every year. It's incredible. And so consumers are paying attention. Certainly governments and regulators are paying attention. There was a McKinsey report out just a month or so ago covering the global regulatory landscape for packaging. And we know that ESG investors who are focused on ESG risk are pushing consumer packaged goods companies to use more recycled plastics in the mix, and importantly, to also really integrate more bio-based packaging that's compostable. So when we're looking at that trend, we're evaluating European pulp and paper companies, forest products companies, one particular in Finland that has done a tremendous job shifting from paper manufacturing to bio-based packaging and selling into the European market and the Chinese market. A tremendous revenue tailwind for a business like that. So that's an example of a long-term trend that's clearly in place and likely going to accelerate over time. I'm going to stop there. So you have ESG risk and environmental thematic investing, very different approaches, but both utilized in asset management today.
All right, thanks a lot, Andrew. In interest of time, we'll keep things going. We'll hand things over to Julie.
Hi there, and good afternoon to everyone, and thanks again for the invitation. I'm going to pick right up from where Andrew left off in terms of framing ESG as both an issue and a domain which requires us to think about opportunities and also to think about risk management. I very much like the fact that, every time that I've heard him speak or look at some of his materials, he insists on framing in that very balanced way. And the reason that I'm encouraged about that is that the ESG field has become very fraught. And so it's probably important for, as part of this educational program, to strip out the things that have become politicized about the ESG field and really double down in trying to understand in the time that we have available, what are some of the essentials? What is it that this field does represent and what might it represent? So first off, I have come into investing and from a very different background because I came into investing from the telecoms industry. And so I was a sell-side analyst for JP Morgan. And in that role, had to provide fundamental analysis on how an industry would move over time and how individual companies would move over time. And what I'm struck by is that very few asset managers and portfolio managers, Andrew is really a rare exception, speak about the fact that fundamentals are as important in ESG investing as they've always been. And so it is not possible to sort of substitute third-party information from a ratings agency or any other source for your own judgment, your own analysis of whether or not a company is actually going to generate value over time. And companies generate value over time when they can actually manage risks. Now, there are forces, there are tendencies as a result of societal change, as a result of climate change. That means that companies are being required to do a better job of assessing risk, disclosing it, having it verified and assured. But that is not to say that that practice wasn't taking place all along. And so the discerning investor should actually be looking for the companies that would have been doing that, even if the ESG regulatory rules and frameworks and so on did not exist. Because from my point of view, that's actually a really good bellwether of someone, a company that's going to create value. Because you're doing the work, you're doing the fundamental work of assessing how are your cash flows, vis-a-vis risks going to increase over time. So that's on the company side of things. The other thing that I think it's worth me speaking about, because I do also come at this from an international perspective, is that the ESG domain has grown as a result also of concern about climate change and our response to climate change. So you wouldn't know it if you were reading the FT and the Economist and the press, that really we were supposed to be hanging our hat on ESG investing in order to solve the gap of the promised 100 billion to developing countries for climate response. That's a failed promise. But yet, trillions of dollars have moved into ESG labeled funds. Trillions of dollars have moved into ESG labeled funds, while at the same time, there's been this broken promise with respect to allocation of capital for doing things like mitigation and adaptation. When we have the second round, I will give some examples of the companies that I support as an advisor to a German investment manager that is active in the Caribbean and Central America, where managing environmental risk and creating value is a very big part of what we do. And also in terms of the advice that I would give to sovereigns in terms of how they can deploy blended finance strategies in order to get ahead of this misallocation problem. So thank you very much for the opportunity to share those points of view.
All right, thank you very much, Jillian. Before we get to Preeti, I just want to remind everyone we've got a couple questions already in the queue. Send those questions through, and after we hear from Preeti, we'll have another potential round of discussion from our panelists, and then we'll get into the questions. So, without any further ado, Preeti, on to you.
Thanks, Matt, and thanks, Andrew and Barry Jillian, for a very lively discussion. So maybe I'll take a step back and touch upon, some of the key concepts. Andrew's already spoken about ESG integration, from a risk management perspective. I wanted to speak specifically to the mega trend of energy transition and the road to net zero. So, as asset owners or managers, we know that we've got a significant role to play in this transition, and we stand to benefit from the opportunities that will be created. And we know we need to get to net zero by 2050. That's a global ambition. I think 90% of the global greenhouse gas emissions are committed under the Paris Agreement, under nationally determined targets. So as investors, we know this will have far-reaching impacts on companies moving forward. So there will be a heightened focus on these companies, that sit in environmentally risky sectors, such as oil and gas, utilities, to develop credible plans to achieve net zero GHG emissions by 2050. There will be increased scrutiny placed on these companies that are not managing their emissions in the reduction path and are not adapting to this transition to a low carbon economy. And in certain jurisdictions, they're also going to face carbon taxes. So these are some material considerations for investors to consider. In oil and gas sector particularly, we're seeing significant capex being allocated to renewables so that those businesses transform over time, and companies that are entering new product lines. So there's a significant shift happening from a mega trend perspective. So as investors, definitely we need to mitigate risk, but also look at the opportunities. And most of the opportunities, I think, can also be achieved through alternative asset classes such as renewable energy farms. Carbon credits is coming up as a new asset class. So there's a ton of stuff that we need to keep on top of as investors. And I think policy support is keeping up. So we spoke about the issues of disclosure. Andrew talked about evaluating companies on what kind of disclosures they're putting out. So I just wanted to touch upon the regulatory support that we're seeing, in at least the developed countries, where SEC is now mandating GHG disclosure emissions across all three scopes, scope 1, 2, and 3, more commonly known as direct or indirect emissions of companies, beginning 2024. Similar regulations are coming to fruition in Canada and the UK in the next few years. SEC is also going to be phasing in required auditing. So there's significant implications from a cost perspective for companies. However, we need to see the balance of benefit. The benefit to investors of having those numbers directly from those companies and not relying on, as Jillian mentioned, on third-party data that may be estimated, may be using, certain assumptions which may not be accurate. So there's a ton to uncover within this mega trend of energy transition, the road to net zero for investors. And another dimension that perhaps I can bring across is, the role of engagement and proxy voting and stewardship from an investor standpoint. What we're seeing is investors across the board are putting greater emphasis on active ownership. So, there's an approach of exclusions, that some of our clients prefer. They would not want to be invested in certain sectors which are considered problematic. But then there's another approach, which is, having a stake in the company and really using that stake, expressing ownership and influencing the company on the path of improvement. We see this materializing in a number of, shareholder proposals this year and last year. The number is increasing. And, this is really a key aspect of stewardship as shareholder, as investors. Say on Climate is a new phenomena in proxy voting. There's a ton to uncover there, and it gives investors an opportunity to voice their approval or disapproval of a company's climate plan. And we're seeing an increasing number of those proposals come through in 2020 in Canada and in the US. Investors are also using this opportunity to engage with senior management and the boards of companies, and voting against directors where they see lack of progress. So I think, it's an extremely, extremely strong tool to influence portfolio companies on the path of improvement. And that's not just from a, virtue signaling perspective. We want these companies to recognize that the world is changing and this is a global ambition. So, either you evolve or some of the business models are going to disappear in the next decade or so. So I'll stop there, and I know we'll have a ton of questions, and I'd be happy to speak to those questions.
All right, everyone was very efficient in that time, but as a moderator, well done. But before we get on to the questions, we've got a number of questions coming through. We had some questions we discussed, Carlos, earlier. We can get to some of those. But before we get to that, does anyone want to add anything to some of the comments that we've heard thus far before we get into the Q&A?
I'd like to just touch quickly on one comment that Jillian made. It's a really important comment, and it's around capital flows and commitments that have been made, certainly to emerging markets. Just in terms of developed and developing worlds, there's a huge need to help the developing world through this transition, right? That's incredibly important. Important commitments have been made, and they haven't really been met. I would personally disentangle that from ESG flows. I think that when we think about sustainability on this planet, there is an investor component, there's a government component, there's an industry component, and then there's a personal responsibility component. And you need all four of those to work in tandem to get where we need to go. So Bloomberg New Energy Finance does incredible modeling around climate change and Paris-aligned targets. And it's pretty clear that given progress to date, we're running out of time. So the level of investment that has to happen can't be pushed through or facilitated by any one of those four. It's going to take all four working together. ESG flows are important because it puts capital to work when done correctly, when done well, in a system that helps move all companies in the right direction, because there's an incentive system in place to try to do a better job of measuring and managing your risk, which can improve outcomes. It's a little longer term and not as direct and tangible for some investors, but it is an important systemic type framework that can contribute, but it can't be the only driver. That's, I think, just a really important point. And then whether we have time for it or not, but something that Preeti talked about, just the idea of engaging with companies, and companies are on a journey, right? You certainly have leaders who are out there who are, look at any ratings agency, maybe it's MSCI, AAA rated companies that happen to tick all the boxes and have a lot of heft behind those numbers. And then there are those that are just coming up the curve. And I would say as an investor, sometimes when you look at the AAA rated, the high rated leaders, they can be a little expensive relative to what we would call transition companies, companies that are maybe not telling the story as well as they could, or just coming up the curve. And in some cases, those can be some of the best opportunities. And from an engagement perspective, letting the companies know what you're looking for as an investor and helping them along that journey can be powerful. And those can also, again, be some of the best investment opportunities out there. But you may be investing in companies that are not currently ESG leaders, and clients have to be okay with that, and not every client will be.
Thank you, Andrew. Those are great points. Preeti, Gillian, anything else?
Well, I would just say that I agree with Andrew in terms of the role that different stakeholders or actors play in solving for sustainability of the planet. And ESG investing is, part of that, but only a small partial part of that. As fiduciary, at the end of the day, our role is to be able to provide sustainable returns to our clients. So, we can never lose sight of that goal too.
And on this point, what I will say is that, I'm sure lots of people are aware of the IPCC report that's just come out. And I think what is important is, as both Preeti and Andrew have said, this is going to take effort from different interest groups in society. But the numbers, the financial investment required to actually get to or maintain, so get down to 1.5 degrees Celsius rise, is estimated to be between something like 1.5 and $3.8 trillion a year. So we're not there. We're a long way from that. And it will require financial innovation. It will require a new thinking about de-risking. It will require not assuming that regulatory push and or labeling of funds as ESG is what's required. I don't know if I have a bias. I think that good old-fashioned project syndicates and structured financing that involves many different parties, including the kinds of investments to build domestic financial ecosystems in the developing world. That's where I think there needs to be additional effort and additional thinking. New thinking needs to not only see this as sort of transfers of funds and other resources, other kinds of capital from one part of the world to the other, but to really strengthen the financial and entrepreneurial ecosystems in small island states, in countries across Africa, and so on. I think that would really make a tremendous difference. And that's something that I've been living for the last 3.5 years with one of my clients who is supporting climate investment and clean energy in the Caribbean.
All right, thank you, Gillian. We're about halfway through now, and we've got a number of questions that have come through the chat. So I'll start with those. I'm going to start with a broad question, and there's a couple that are more linear or more granular in nature. I'll start with a broad question, and then I'll cheat. I'll answer it a little so you guys can think about your answers. But the first question is how is ESG incorporated into the valuation of companies? And my answer, and we'll see if everybody agrees with this. My answer is don't worry about how, but worry about doing it. We at CFA Institute undertook a project with PRI, Principles of Responsible Investment, about 5 or 6 years ago. And we went around the world, back when you go around the world, and we talked to investors in 20, 30 different markets about the current state of ESG, where it's going, how they do it. And as part of that process, we partnered with 31 different financial firms investment managers and ask them to write case studies on how they integrate ESG in the investment process. And you can look that up. It's, look up ESG, the case studies, PRI, CFA Institute. And that's a great lesson of each of these companies does things a little differently, whether it's fixed income or equities or sovereign debt. Their processes are going to be a little bit different, but they all have a lot of the same fundamental steps they take. They use ratings, but they also use internal ratings that they get to. So the short answer is get started building that expertise and how it's done. And whether you're a firm of 5 people or 5,000 people, get started on that process and use things like those case studies and the people we're talking to today as great resources to learn how that can be done. And I'll hand that off to everybody else.
I'm happy to take a quick stab at that. There's, I guess, first comment is there's no one right way to do this, one right way to integrate ESG into the investment process. An investor has to, be true to their investment approach, how they think about valuation, how they execute on that on a consistent basis, and then, integrate appropriately. Sometimes it's quantitative. Sometimes it's part of a DCA model. Sometimes it is, adjustment to discount rate. Other times it's directly a line item. It may result in higher or lower costs of goods sold or other line items that's in an income statement. And then you take that down to earnings and earnings forecast, and you're putting a multiple on that. I've seen some people adjust multiples. So there are many ways to do it. Some are a little more scientific, some involve more judgment. But to your point, Matt, it's about doing the work. It's about, again, from my perspective as a fundamental active investor, we're going deep in companies and really trying to understand what makes them tick and their competitive position and the industry dynamics. And a lot of that is building a mosaic and using judgment. And so I think that's just really important to understand. Personally, I appreciate quantitative investing, but I think you miss a little bit when you're only looking at the numbers and you don't understand some of the context. So I would encourage people to think broadly about it and use judgment.
And to add to that, exactly what you said there, the phrase I like, and I stole this from somebody else, so I can't take credit for it. But at this point, ESG, integrating ESG in the investment process is more art than science. And I agree with that. A lot of us on this call are financial people, we're math people when you get right down to it. But we've got to have a little bit of humility about the state of ESG right now, and that there's a lot of art to this and doing the work to understand either the sector you're talking about or the issue you're talking about. And there's not always neat numbers that you can go out and find that tell you that story. So it's a mixture of art and science, and you have to be able to understand both. Anyone else before we move on to the next question?
I would just add, I agree with both of you that there's no one right way to do it. It depends on the strategy. We talked about quant, for example. Yes, of course, quant does not have the ability to stock pick and do fundamental equity, and it's driven by factors and metrics and data. At the same time, there is some hard data that quant could use on ESG investing. Carbon risk is one of them. Quant can include, carbon data to make sure that, from a carbon tax perspective, from a regulatory standpoint, depending on, what markets they're exposed to or what benchmark they're following, they're able to mitigate that risk by ensuring that perhaps their number is less than the benchmark, or hedge it, based on some of the other volatility factors in the market, right? So I think, every strategy is going to have their own way to do this. In real assets, I think it's extremely important to consider physical risks based on climate change. Where the asset is located, what sort of extreme weather events it's exposed to, how resilient those structures are or can be in the construction phase. So I think, you have approaches all across the spectrum, depending on which asset class you're talking about, which investment strategy, and what geographic exposure or benchmark you're following.
Jillian, anything to add, or shall we move on? We've got plenty of questions, don't worry.
I'm good.
Okay. Something a little bit related, and this is talking a little bit about, a lot of people here on this webinar have taken or are going to take the ESG certificate, the CFA certificate in ESG investing. And this question relates to that. In your opinion, what is the biggest skill or focus area students of ESG focus should focus on in terms of market requirements or need? Wow, we could talk about this for quite a while. But I would say get started. There's a broad panoply of things to do in the ESG world, but I'll leave it at that and leave it to our panelists to say more.
Let me take that one. I think that it is, I have a lot of sympathy because it is noisy and might be overwhelming. But I think that what is important is, and the message that you've been hearing from the panel is that industry knowledge is important. Knowledge about I love the phrase that Priti used, mega trends. So what are the kinds of regulatory and political developments that you would need to take into account as a in-company ESG analyst or an analyst in a third-party ratings company or even in a financial institution. But I think that and you also should be aware of the climate science itself for the environmental aspects of what you're doing. And so that requires a kind of intellectual curiosity. It requires continuous learning, which I think the CFA Institute actually really provides well.
Maybe I can just add quickly to that. As a fundamental active investor, starting out, I read Graham and Dodd. I mean, you go back and you learn the history of the market that you're in, and history is never, it can rhyme, right? So you want to understand past cycles and how things have happened. I think it's really, really important in this space to understand how all of this came about, how the market has matured, how it shifted. It helps you really understand, the context behind the different approaches that are in the marketplace today, and it helps reduce some of that noise and helps you find the signal. And that is then very valuable to any employer or customer that you're working with. So I think it's just understanding that history and that context. You can't move forward without understanding what's already happened.
Yeah, Matt, and I might take a different tack here and say that, there's a very wide variety of roles out there in the ESG space. And every individual needs to, first question, what is it that they want to contribute? What role they would want to be in, what sort of ideas or impact they can bring forward. Because increasingly, as I'm talking to, people who would like to enter this space are very much impact oriented. So if that's something that you want to do, then, maybe a regular mom and pop, traditional asset manager is not the space for you, right? So I think, what drives you really defines where you want to be in the space.
That's a good point. All right, moving on to the next question. How do you think leapfrogging in developing countries, move us straight away in low carbon energy rather than maintaining existing high carbon infrastructure, will affect the economies in developed countries that are struggling to transition to low carbon? This is, similar to the cell phone model where countries didn't ever have to deal with landlines because they just went straight to the new technology. I think there's kind of two questions here. The opportunities for developing markets to jump into those clean techs without having to go through the more dirty infrastructure, and how will that impact developed markets? Anyone?
I'm happy to just, there was an article out today about on Bloomberg about a company that is doing very, very small scale individual home solar in Africa that was backed by Tesla. And it was not the most positive story on this company. And it gets at some of the problems that we've seen historically of trying to actually invest into some of these markets, create an investment case or an impact investment case in these areas. And sometimes profitability comes into play and volumes come into play. And sometimes the incentives aren't always aligned correctly and they don't always work out. So it's a challenge, but in some cases it's necessary because the investment in a full scale grid is very, very expensive. And increasingly what we're finding, even in countries like the US, is that power is being generated in different ways. And we are absolutely seeing microgrids, off-grid generation. And so there's no reason those can't be used elsewhere in the world. And that may actually benefit those countries and companies who are involved.
Yeah, and I think, a lot of the opportunities are also being driven by the policy framework. Let's say in India and China, for example, both the countries have commitments to, achieve net zero by a certain time. I think China was 2060, India was 2070. And, understandably so, that it's not equating with the developed countries' commitment by 2050 because, these countries are yet to reach their economic potential. So there's a little bit of that climate justice aspect to that. But I think going back to your question, Matt, there are tremendous opportunities there. I think the lowest hanging fruit is to wean them off of coal. We know that coal is the highest, potential energy source from an emission standpoint. There's potential in, switching at the cost of being controversial to nuclear, for example, or renewable energy. There's a ton of, small micro companies that are popping up in those countries on solar panels and making it more economical, scalable, achievable for a multitude of different clients. So I think as companies with their supply chains as well as operations in those countries commit to net zero, they will be looking at not only their operations in the US and Europe, they'll be looking at their operations in China and how do we reduce emissions there. So I think there's tremendous opportunity to leapfrog on this.
Jillian, anything to add before we move on?
I think the interesting thing is that even without new technologies, so even if you take out the leapfrogging element, in many countries across the continent of Africa, you have an electrification need, so that there is an opportunity to put in energy infrastructure and to do that using lower carbon, less polluting energy technologies. And my hope is that we will actually be smart enough to develop learning laboratories where, because the questionnaire asked about what might this mean for the developed world, right? And especially at this point in time where we're thinking a lot about energy security, it might well be that the kind of experimentation that is done to solve an electrification challenge might actually also help with an energy security challenge. And so I'm hoping that there will be the kind of partnership across different parts of the world that would make that a reality.
Oh, that's a great point. Next question gets to something we discussed on our call between us a couple of days ago about private markets. The question is, public companies in the public space are regulated by investor demand and, of course, regulation. How do you see private equity and private company space in terms of ESG risks and opportunities?
It's a really good question. It's changing rapidly. I would say that, like you think about the public markets, there are different approaches. You can take things out. You can emphasize certain types of themes. You can think about risk. It essentially is the same thing in private markets, or should be. And there are many different strategies: private equity, private credit, infrastructure, a whole host of them. I guess really big picture, last I checked, when you think about foundations globally, annual spending from foundations granting is like $500 billion globally annually. And in impact in private investments, committed capital is over $2 trillion. So if there's an ability to take an impact lens and use that across private investing, there's a real opportunity to scale impact and recycle capital. So it's potentially really powerful. But it is kind of earlier stage. So we have a due diligence piece of our business looking at private markets across the spectrum. And if you think terms are used interchangeably in public markets, it is far worse in private markets. And so you see funds that have an impact label, an ESG label, or a green tech label, and they're all trying to position in this market for capital. We really believe that you can use an ESG framework if you're looking at companies, if you're in private equity or a hedge fund. It's essentially the same approach when you're thinking about risk. So if a fund comes labeled as an ESG fund, they should be able to talk about their ESG framework and how they use it to manage risk. We also know that survey work of ultra high net worth investors around the world points to climate change as perhaps the most powerful investment trend seen by this group of people. 70% said it was the most important trend of their lifetime. So a lot of funds are going out and acting like thematic funds, but acting as impact funds, but can't measure the impact, and it's not intentional. So you have to be very careful. I would use the same framework in public markets on private markets and be very careful how the capital is invested.
Yeah, one of the key challenges in private markets is, availability of data. If we thought ESG data is bad in public markets, it's worse in private markets. And, there's generally no assurance around that data. So I think, the onus is really upon investors to be able to make sure that, what they're investing in, if it's an ESG impact fund or labeled fund in private markets, they really do their due diligence. Unless it's a thematic fund, which is, let's say, infrastructure, fully invest in renewables or something along those lines, I think, which is easier to corroborate. So I think data is a huge challenge in the private markets, but at the same time, the opportunities to solve for issues such as the UN SDGs through private markets is huge.
All right, hearing nothing else, I'll move on to our next question. Preeti, you mentioned engagement, but there's a specific question about thoughts of engagement effectiveness for bondholders, particularly.
Yeah, that's a good one. So we've thought about that internally quite a bit, and our engagement approach and the way we've tried to solve for it is that, cost of capital and cost of borrowing is going up for high risk ESG sector and companies. So when we devise our engagement framework, we try to look at it from both equity and credit perspective. Being a very large asset manager, we're generally invested on both sides. So we are a lender as well as a shareholder in the same company. And that really lends well to our voice when we're talking to the company on ESG issues or improvements we'd like them to make, or how they're tying ESG factors to their performance. So I think if we were to look at it from a credit perspective, the quality of the company to service a loan is critical. And engagement can play a big role when it comes to really high profile ESG, unmitigated ESG risks related to an issuer. It's a different story on the sovereign side because, there's a fine line between lobbying and engagement on ESG. So we always need to think through what is our investment thesis when we're engaging with issuers. Is it really driven by the investment proposition, or is it something that, maybe more values driven?
Anybody else before we move on?
I think the big difference is, and I think Andrew picked up on this, where's the direction for the interest or the trigger coming from? I think in private markets, it's going to be coming from your GPs. It's going to be coming less from, the regulatory lens. And I think that then has an important implication for how you manage or integrate ESG into private markets. And I think Preeti was the one who also talked about the importance of assurance. If you are requiring or just getting disclosures directly from companies, then you're going to have to really be sure that you're doing your own due diligence in a way that you would be able to rely on third-party information a bit more and ratings and so on for public markets.
All right. We got about 10 minutes left. We got a couple of questions, so I'll try to get through as many of them as we can. What are your thoughts on the impact of the conflict in Ukraine? Will it act as an accelerant towards alternative energy, or will it delay transition as people focus on short and intermediate term energy needs?
Yeah, I'm happy to just start there, maybe. So Europe broadly, including the UK, so the region, is clearly dependent on Russian energy. I want to say it's 40% of oil imports are Russian and 60% of natural gas imports, these are net imports into the region, are from Russia. So stepping away from those is a tremendous lift. We know that the Repower EU program that was announced just a few weeks ago calls for stepping away from 2/3 of natural gas, Russian natural gas this year. So the only way to do that is increase LNG flows. And so what we've seen is, again, natural gas prices are very, very high, higher than they are for LNG-linked contracts in Asia. And so that's going to pull LNG into Europe. The infrastructure is not fully there.
I'm sorry.
So I'll get there. But I guess the point is that what you end up with is because of the structural need to import gas, you're going to get much higher gas prices and higher power prices. That then sends a very powerful price signal to the marketplace that makes alternatives, which are already economic in most cases, much more attractive, right? So it should absolutely accelerate the development of alternatives. It also, interestingly, currently makes green hydrogen profitable in Europe, which was not expected before 2030. So it's unbelievable how fast things have changed because of what's happening in Ukraine. And we think that's structural because the EU is not going to go back to Russian energy.
Right. Yeah. Yeah. The discussion of green, gray, and blue hydrogen is a fascinating one that we should do. We could do a whole webinar on that. But just people keep that. That's something that's coming that people should look out for as well. Preeti and Jillian, anything there?
No, I just agree with Andrew. The economics of it is really powerful, right? So we've seen Germany make commitments advancing their ambition to be net zero 10 years earlier because of this conflict, because they recognize that, they were relying on an unsustainable energy source and producer. So I think, going back to your question, I think it's going to be a huge accelerator to wean us, or Europe specifically, off, fossil fuels, especially coming from unsustainable or, regimes which are dictatorial.
Jillian, anything to add before we move on?
I think one point that I would make, the suffering and so on in Ukraine is very tragic. And I think it's not going to be the last. I think that we are heading for a time of unpredictable events, whether it's extreme weather events. The Caribbean is used to that. We're seeing now a war in Europe, which hasn't happened for a while. But I think that the ESG sustainability conversation really also should be including notions of crisis management and resilience. And if that's something that comes out of this strategy, I think it would be a good thing, because I don't think that it's going to be the last time between now and 2030 that we are having to, as a world, make some pretty, difficult decisions and make some structural changes that we thought were impossible.
Right.
They've speeded up as a result of a real a trigger and unprecedented event.
If the path through COVID is any example, I agree 100%, right? When the world needs to come together to solve a challenge, we can get things done pretty quickly. So we just need to come together and get it done.
Yeah, but Matt, one thing that and I think generally is not talked about in the market, sort of like the ESG implications of the war, is really the impact of taking away almost 40% in some cases, some of the food commodities. Ukraine and Russia are huge producers of wheat. They're huge producers of fertilizers. What downstream impact that's going to have on countries that were importing from those two nations? And, does it contribute to food insecurity?
Yeah.
Absolutely. And are we paying attention to that? Nope, we're not.
Yeah, you stole my thunder. I was going to mention that the last time we had this kind of disruption in the wheat markets. Russia, I believe, is the world leader in producing wheat, and Ukraine is number 4, I believe. The last time something like this happened, disruption, and this is more than that, was the Arab Spring, I believe 2010, because of wheat prices were so skyrocketed so much. So there's huge implications beyond just what we think about as ESG energy issues. We have about 5 minutes left. We're not going to be able to get to all the questions, but I want to get to as many as we can. A similar question, a related topic. What would be your opinion about the introduction of nuclear in the ESG universe, especially small modular reactors? When you think about it, think of we just talked about, a lot of Europe getting 40 to 60% of their energy from Russia. One European country that doesn't have that problem is France. And about 70 to 80% of their power is nuclear. And so, in the wake of Fukushima, nuclear was a word people didn't talk about, but that's being reconsidered now. What are y'all's thoughts on that?
I can kick that off because it's very timely. We just, not to sound promotional, but it's actually a very educational piece. We came out with a white paper on going beyond perceptions on nuclear and really science-based analysis of nuclear and latest technological innovations around it. We're very positive on nuclear as a source of energy. We think that if you compare the entire life cycle analysis of emissions, nuclear is actually the lowest, even lower than renewable energy, which requires manufacturing of wind turbines, which requires manufacturing of solar panels, mining. Of course, nuclear requires mining too, but not at that scale. So I think, we're pretty positive on that. One thing which is always challenging about nuclear is, obviously perception and some of the health and safety issues with the, radioactive waste. And we address that in the paper. So anyone who's interested in that, I think, I'm happy to forward it along to the CFA Institute. But I think what we're arguing is that nuclear, if you look at historical track record, is actually one of the safest source of energy if you also add in air pollution related health issues. So that's my answer, but I'll let Andrew and Julian speak to that.
I think you said it all. I agree.
Go ahead, Andrew.
No, I agree. I think it should be part of the solution. I think you look at what Germany's done over the last decade around nuclear, that maybe wasn't the best move. And certainly the designs that you have today are very different than what's been put in place over the last number of decades. Much safer, much cleaner. Think about like thorium as a fuel and other types of fuel sources that are just and technologies that are more efficient. It's a different story today than it was in decades past.
Julian, you get the last word.
I think I'm echoing my colleagues because I think it's about smart, safe, and also having an energy mix that is doing the kind of analysis about lifetime costs. So once countries are doing that, then there seems to be no reason that nuclear cannot be part of the mix if it is properly managed.
All right, well, I'm going to stop the questions there. I apologize if we haven't gotten to yours, but we only have a couple minutes left. So first of all, I want to thank my panelists, and I want to give each of you a minute or so to kind of summarize your thoughts, and we'll start with Andrew.
Thanks, Matt. Thanks, Preeti. Thanks, Jillian. Really a pleasure being with you all today. I would say that very quickly, I think that the biggest issue facing this industry, this part of the industry today, is greenwashing. And the way to manage that is to understand the various underlying approaches and try to speak about them consistently. So the CFA Institute product level disclosure standards are really, really important. I would encourage people to read those, understand those, integrate those, and think about the language that's used there. I think that's just super important. I try to differentiate between ESG as risk and thematic environmental as opportunity and growth. And there are other approaches, but just really understand those. And if we can all speak a common language, we're going to do away with greenwashing.
Jillian, your thoughts?
I want to again thank the CFA Institute for this invitation, and my closing comments would be about continuous education and learning and the importance of seeing investment, whether you're an in-house analyst or you are portfolio management, as actually combining different forms of capital. So financial capital in combination with knowledge capital, in combination with social and cultural capital, having an awareness of how you are actually helping finance to do good. Because I think it's an important part of what we need to do in our societies. And I think the CFA Institute and discussions like this one are very positive and useful for what we have to come together to do. So thanks again.
All right, Preeti, you have the last word.
Yeah, and thanks, Matt. And it's a real pleasure to be on this panel with Andrew, Jillian, and yourself. So thanks again for the invite. And yeah, I mean, nothing more than what Andrew and Jillian already mentioned, but I think, for all CFA ESG certification aspirers, I would add that, the health of capital markets depends on sustainability of our planet and sustainability of our institutions and systems. So it's extremely important for any investor or anyone dabbling in this space to understand what those could mean to your process and start from there. Thank you.
All right. Thank you, everyone, for joining us today. Again, thank you to Andrew, Jillian, and Preeti. I hope we had an enlightening conversation for you. Take care and see you all soon.